So, what's unique about Elrond? Now, if you guys have heard of this sharding, database sharding, we're going to talk a little bit about what is sharding, just so you guys have a basic understanding of what sharding is. And again, most of our community currently is traders who are trying to learn about cryptocurrency. If you're a cryptocurrency expert or developer, and this might bore you a little bit, but maybe you can take something away from the trading and the charting that we're looking at, and how we navigate the markets on the charting side, right? All right. So one of the biggest core pieces of Elrond is its adaptive state sharding. So, Ethereum 2.0 is going to use a sharded ledger. So they're going to break up the ledger into multiple pieces called shards. And there's going to be 64 shards in Ethereum's network. It's going to be a set 64 in Ethereum 2.0. Now, Polkadot has a set 128 for its Polkadot parachain. Each parachain is basically a shard. And so in Elrond, they have adaptive sharding. It means that the number of shards will go up and will go down based on utilization, based on needs. And this is great, but on one end, it says this sounds really great and really cool. On the other end, there's some caveats with that we need to know about. They introduce a modified proof of stake called secure proof of stake, and they claim, like any other proof of stake, they're Byzantine fault tolerant. So what is Byzantine fault tolerance? We'll talk about that. So let's talk about what is sharding. Now, all sharding is taking a database. If you guys know what a database is, you can think of it as a dynamic Excel spreadsheet, right? But with the database, you have a table, you have some type of identifier field, and then you have some information. So typically. So the simplest example of a database is like a customer, information database. So if I just have a list of my customers, that can be a database, right? And so each customer might have just an ID of some type that identifies them, and then I have their name, maybe their address, phone number, contact information, whatever, right? And maybe their account balance or something along those lines. And that can be put into a table pretty simply. So you can see how a database would store that data. Now, databases can store a variety of data. Sometimes, the information about certain fields is left blank and it's filled in for others. And so there's some ways that these relational databases use that key field to tie all this data together. So with sharding, all sharding is doing is taking basically this table, and you can think of it in crypto, it's very simple, right? So instead of customer ID, it could be wallet address, right? So wallets on a blockchain are pretty much your main identity. And you have an account balance to keep it as simple as possible, not getting overly complex. More advanced cryptocurrencies have more metadata, which means more information about something, right? So when we talk about metadata, we're talking about more external information that gives you the context about something. But there's a lot more metadata that can be written to more advanced blockchains. But let's just focus on what like Bitcoin does today, right? You have a wallet address and you have the unspent transaction output. How much available Bitcoin do you have to spend for that wallet address? And that's the Bitcoin ledger. So taking that further, Ethereum, Cardano, Elrond, they layer on some additional information so that you can write things called smart contracts, which are the ability to program, when this event happens, then move these funds, basically, right? As simply as we can make it. I'm trying to oversimplify this as much as possible. So this is what sharding is. It's taking this maybe instead of a customer, you might have a wallet address, and in the case of Elrond and the white paper here, you'll see that they use horizontal partitioning, right? So this horizontal partitioning, what they're doing, so they're basically breaking up wallets and their associated information with that wallet, and they're putting as much information and they're organizing it by shard to as much relevant other wallets as possible. So what that means is, now in here, let's just start reading through here real fast. Adaptive state sharding comes with additional challenges compared to the static model. So I just want to start with that. So we talked about this earlier. With Ethereum, it's a static shard, right? So there's 64 shards, so it's a static model. But with Elrond, they're adding additional complexity by making these shards adaptive. They can spin up more, they can take them down, reduce them, which is highly complicated with sharding. So they're talking about the ability to organize the shards. This is the first challenge in every shard approach. The mechanism that maps nodes to shards has to take into consideration possible attacks from attacker that gains control over specific shards. Transaction sharding handles the way transactions are mapped to the shards where they will be processed. So what they try to do is they try to make sure that when you have both a smart contract and addresses that are using that smart contract, they're co-located together on the same shard so that they're locally processed together. Now within a shard, everything's processed together. Now if one shard, so say this horizontal partition here, if we have to take some customer data, right, so say this customer data field also at the end of it has an account balance. If we need to move part of the account balance from one customer to another customer in this field here, right, what you're going to do is you need some external way of communicating from this shard to this shard that this account balance is now not 100, it's 50, and this account balance is not 50, it's now 100, right? And that in the Elrond network is called the metachain, is how they cross communicate that. All right, let's go back through here just to be aware of, and let me just pause and share my background and why I'm a little bit hesitant on sharded ledgers in general. Why Ethereum 2.0, I keep saying there's challenges and it's not going to be completely without any sort of risk. And then Polkadot as well. Why I'm not, why Polkadot wasn't ever bigger of a position than say Cardano for me. Polkadot's a fantastic hedge against kind of single chain maximalism though. It's really a multi-chain system. But you see here, sharding introduces some new challenges like single shard takeover attack, cross shard communication, which is talked about that's how you do in the metachain, data availability, and the need for an abstraction layer that hides the shards. And this is super critical. This is actually the core of what makes this adaptive state sharding work, is this abstraction layer that hides the shards, okay? Now, if we go down here, I want to highlight some things for you. The context switching represents security improvement, but also increases complexity required to maintain consistency between multiple states. I just want you guys to know, this is a fantastic project, a lot of upside, but I'm really kind of focusing first on the risks so that we can try to then define how they're working around these. If the current block proposer acts in a malicious way, the rest of the group members apply negative feedback, rating to decrease or even canceling changes, the particular node will be selected again. All right. So in addition to help prevent against a lot of these issues that we're going to be talking about, they have, not only is it your stake, so the part of the secure proof of stake in Elrond is not just, in proof of stake, it's how much stake do you have. The larger amount of stake you have, that stake pool is going to be selected more frequently to mint new blocks, right? And then be paid out a higher proportional reward because a reward proportional to their stake typically. Well, in Elrond, they're actually also introducing a reputation scoring, which a lot of proof of stake systems will likely do, and to help with that. Okay. Now, here's before we move on, here's the biggest risk I've been able to identify. You see this right here, this shard access layer. Now this is talking about your Elrond, your Arwen VM, and access to smart contracts and the VM, the Elrond VM. That's a WASM VM, WebAssembly language VM. To get access to the shards, to be able to read and write and move, count balances between entities, and to itself also have a balance potentially. There's this thing called a shard access layer. Now, this is literally the most critical piece of all of this. Now, if you're going to have this very advanced, very complex sharding system, the way that you assign accounts, wallets, smart contracts to the shards to be able to optimize that the shards are local, optimized locally, as well as to maintain that balance is incredibly important. And I want to show something with you guys. So if I search this whole article for shard access layer, you don't find that exact language anywhere in this document. It's only on this diagram right here. Now you'll see here. So you see this statement right here. It's all, I put the word, it's all magic. The Elrond virtual machines implementation will hide the underlying architecture, isolating the smart contract developers from the internal to ensure proper abstraction layer. Okay, so the most critical element, in my opinion, to the entire infrastructure, there is no detail about it in the white paper at all. And the only statement here is that we're gonna hide it. We're gonna hide what's going on here. So this is where I went to, and I started searching. I went through Twitter. I asked Twitter, I said, hey guys, can somebody out there on Twitter Does anybody have the details about how this incredibly important, critical piece of the infrastructure works? And one of this great guy to follow on Twitter, by the way, CryptoText. This guy has put out some fantastic information. I was reading through a bunch of his stuff. It's great work. I have not yet been able to get to the bottom of this whole shard access thing, and I will report back when I do. He was able to provide the open source GitHub, and I've been trying to dig through there to see, if I can figure out what. And this might be a very very simple layer, and it might not be that complicated at all. And so it may not be that big of a deal when I get to dive into it. But so I was provided, the GitHub repository to go search that down. So it means I got to go dig through the code myself and try to see if they have these elements written in a publicly available code somewhere, so I can reverse engineer the code and see how it actually works. But you'll see I went on to the developer page, right? So I went on to the developer Telegram and I asked the developer Telegram. And I got responses from the CIO even, who said, "Hey, Brandon, have you read the white paper?" Well, yeah, I've read the white paper multiple times. And then I got a comment from the CIO. "I'm sure you get a quite detailed overview about the current implementation. I have yet to receive anything at all about this, the most critical part of the system." So that is one pause that I continue to have until I understand this. And the reason I really want to understand this, let me explain why I think it's so important to understand this. If you go look here back to this article we were looking at, benefits of sharding, there's a lot of benefits. Scale, horizontal scaling. And so let's talk about the benefits real fast. All right, with a database, databases are typically disk intensive. That means that they have a requirement for data input output, right? So they need to write a lot of data potentially to disk. You need a lot of storage available, non-volatile storage. And then disk I/O is really important. It's one of the other important areas. How fast can you read and write that data? How fast can you write it, and how fast can you pull it out and access it, right? That's the other really critical piece. And then third is memory. So your volatile memory, so your RAM basically. Because you got to store certain components of that to be able to organize the database and process certain parts of the database. It needs to be able to be held in memory for quick access. And this is especially true if you're trying to do advanced querying against it. Now, the compute power, how much compute resources, is not as important with a database specifically. Now, with blockchains, it becomes more important because you're trying to compute smart contract outcomes. So you're taking a lot of inputs, you're processing, the states of different things, and you're calculating an outcome. So it does come into play. But with the sharding, it doesn't necessarily come into play. But there's multiple what we call KPIs, key performance indicators, that we have to watch with databases. And sharding, if you see here the drawbacks of sharding, the first difficulty people encounter is its sheer complexity. If done incorrectly, there's significant risk that sharding can lead to the lost data corruption, corrupted tables. And when done correctly, there's probably even still caveats. Rather than accessing and managing one data from a single entry point, users must manage data across multiple shard locations that can be potentially disrupted to some teams. And then another major drawback is that it's very difficult to get back to an unsharded state, which again, I don't know exactly. I haven't been able to figure out exactly how they reduce the number of shards in the adaptive state shard architecture with Elrond. I don't know how they reduce the shards yet. I'm trying to figure that out. So there's some caveats here, and then isn't supported. But this article somewhere highlighted that layer, and as well as the white paper identified that layer that we're talking about is the most critical piece. Is how do you organize these shards? Again, the reason this is so important, let me pull back up the white paper. If a malicious person got access to the decision criteria, then maybe why they're hiding this, right? I don't know. But if a malicious person got access to this, what you could do is you could craft certain smart contracts, and this is theoretical. I don't know that this is a vulnerability or a possibility. But you could craft certain either messages, transaction types, or smart contracts, however you can get access to this layer. You could potentially craft certain smart contracts so that all of that data that's all of the interaction for that smart contract is landing on a single shard. And if you're if you're a malicious actor, what you can try to do is freeze or lock up the system by writing specific malicious code in a smart contract such that all of that data lands on a single shard with the purpose of exhausting the resources. So within Elrond, you have and other proof of stake networks, Cardano, Ethereum, Polkadot. None of these are exceptions. There are minimum requirements for running a node, and a large portion of that is that we can't have this resource exhaustion happen. It will corrupt. It can corrupt the database, which is extremely bad, right? If nothing else, in this case, what we're mostly dealing with is transactions that are in process on these shards, and it'll be written to a long-term blockchain, and there's some with Elrond specifically, they do what's what I'm looking for, not randomness. Let me go find it here. They do pruning, right? So they prune back. They use a pruning algorithm to prune back, and if at the end of the epoch, they if consensus reads a block prosper, will store the shard ledger, making a genesis block for the epoch. So they roll up all the transactions in something called the Merkle tree, which is a representation. It's a tree of all the transactions, and there's a signed root that represents all those transactions. Okay, well, we won't get into that. But in theory, you could, again, try to craft certain things to where you overload one shard and you exhaust the resources of the nodes running on that shard at that particular time, and then lock up the entire chain. The reason I say this is a risk is because I've experienced this in the real world. So I'm not I'm an technology infrastructure veteran, 20-year technology infrastructure veteran. I've dealt with a lot of mostly data networking, security, that type of thing. I ancillary deal with databases, but what I do know is I've had databases that were sharded databases that the team set a certain number of shards. Say it was 4 shards, right? And what that does is those shards help spread those KPIs, those key performance indicators. So if you've got a database that requires more disk I/O, say disk input output, than a single server or even a storage network can handle, then you can spread that out into multiple shards for scaling and split that across multiple physical infrastructures and scale up your input output, right? So if your limiting factor was disk I/O and you need to scale that up, especially before we had SSDs, right? You say you had spinning disks, you need to scale that up. You can split your database into shards and spread that out. The problem is if you're not very careful about how the shards are organized and how they're managed, you can have one shard get overloaded. So for the example, what happened in my case was there were 4 static shards, and there was a change in the application behavior. So instead of, let's do the customer database example. This isn't exactly what happened, but this is a good example. So say the application were to change, right? And let's say for some reason, I don't know, a lot of people with the last name starting with the letter A started using the system. If you get enough people with the letter A using the system, if the way that you split up your shards is that A through whatever goes on one shard, and then G through whatever goes on another shard, you split it up by the first letter of somebody's last name as to which shard they land on. That's how you handle your access layer. If the application changes, and all of a sudden maybe the application starts adding an extra A on everybody's last name for some reason, it's coded in the application to do that. Then all of a sudden everybody's data lands on shard 1. And then all of a sudden you have an overload where 50% of the database is running on a single shard and overwhelms the resources of the nodes running that shard, and you get corruption and all kinds of really bad things happen when you run into node exhaustion on a single shard. Okay, that's why I think this is so important to understand exactly how this access layer works. And exactly how that's mitigated. The meta chain will allow communication between the shards, and then the pruning will clean up unused things in the shard. But if you have a situation where you're inadvertently overloading one specific shard, that can be a problem. And the other thing too is back to my presentation here. What we want to understand about every crypto project is how does it perform under using mitigating controls, right? So you hear a lot in the crypto space about here's the throughput, here's the max theoretical throughput for something. Well, the reality is now sometimes everything's hunky-dory and the network is humming along at peak performance. But there are times when the network has to spin down and protect itself from bugs, Byzantine behavior, which means that there's bad actors. There's maybe nodes that are corrupted or nodes that are malicious, exposures, vulnerabilities. What is the performance under those conditions? And this is another question that I've asked for the Elrond team to try to get some information from. We'll report back when I have more information. This is incredibly important. So, for example, a lot of the hash-based ledgers have a hard time under attack. And they have to have a very centralized component to help orchestrate that network so that it can continue to perform okay under attack. But if it doesn't have that particular node, it will crumble under an attack and basically crawl to a stop. I'm sorry for the dog in the background. All right, so that's a lot of talk of technology. Let's get back to trading. So that's my upfront, the concerns that I have. Now I spent a lot of time on that trying to explain all that. And what is Byzantine fault tolerance? This is every crypto project has this. I do want to help everybody understand this real briefly. Byzantine fault tolerance is, if you think about it, if you're trying to attack a Byzantine tower, it's a very difficult thing to take a Byzantine tower. But the Byzantines, if you ever played Age of Empires, were a super defensive civilization in Age of Empire, really well known for their towers. If all the generals who are trying to attack a tower or commanding different forces don't agree whether you should attack or retreat, your attack is going to be weakened if, as you see here pictured on the right, a few generals decide to retreat while other generals attack. So everybody needs to agree and have it come to the same consensus. Everybody has to agree at the end of the day, which is very much what consensus is in blockchains. Everybody has to agree to the transactions that happen on the blockchain. And then rogue generals shouldn't be allowed to adversely affect the decision. So if you have rogue compute nodes, they should not be adversely allowed to affect the decisions. Okay, so that's what Byzantine is. So all these proof of stake systems are Byzantine fault tolerant. I'm sorry about the noise. I'm getting distracted here. So I did want to go down that rabbit hole here a little bit with you guys. Now back to looking at, let's see, what was Bitcoin doing this morning here, 4708. So this is our main watermark for how the crypto markets are doing. Now I want to show you another chart, and I'm gonna go back to Elrond here. What I'm really watching is these horizontal levels. There was a tweet somewhere out there. Somebody tweeted that I tweeted this clone trend line. So what I did is I took these top touches of this uptrend channel that we're in, and I cloned it down here. You can see the interaction down here, and you can see that we started to break down here. But if I take this very bottom touch and clone it as well, you can see that's actually where we found support. Now if I can find this feed, is that my Gemini feed? If I can find this feed, let's see if that's where we ended up finding support at. Right there. So that's the clone trend line I posted last night. Look at how that's interacted. Now what we added on here, a comment on that tweet, was that trend line isn't applying here at this point. Bitcoin is respecting horizontal support. Patience is required though. So if you look at the horizontal level that I added here, is this daily support and this weekly low that he talked about this morning are incredibly important. So we came into this daily support that I had, 48.6, and that's where we got a bounce. And then this weekly low, we don't want to take out this weekly low. That would be an indication of weakness, right? Now, if Bitcoin rolls over, everything else is going to roll over. So just know that. Now, right now, Bitcoin dominance has made a big move to the downside again. So this also is part of why Elrond is specifically breaking out to the upside. And then Elrond USD over here is looking good, consolidating above this breakout point. All right, let's go take a look at comments. I'm not going to try to give any trading advice about entries here, but there's some potential entries coming up. Depending on it, totally depends on your trading style. If you're trying to buy coming into support, that's one thing. Let's look at the moving averages here real fast on the USD chart for Elrond actually. Yeah, this is actually pretty nice. So you've got a nice confluence where they've kind of constricted here. So you've got multiple moving averages that are in a pretty tight range, relatively speaking. Not too terribly tight, but you've got the 20s crossing all of them. The 50 just crossed the 120. The 120 is below, just like Bitcoin. This looks a lot like Bitcoin. It's pretty much the same chart as Bitcoin, actually. But you can see here we broke out of if you're looking for a level to retest, I mean, honestly, you can look at these levels too. See where the 20 ends up over the next couple days. All right, back to comments. Any questions on Elrond? Now, I spent more time on the parts that I'm still trying to dig and figure out. Elrond, back to the positive. Elrond is probably the most advanced single layer blockchain there is. Probably. ETH 2.0 hasn't got there yet, and even when ETH 2.0 goes there, there's a lot of advantages. One thing I didn't put on here, smart contract state sharding. This is a huge benefit. So, back to talking about Elrond's positives. Elrond, unlike other blockchains, Zalika being one of the big ones that did sharding, but what they don't do is they just do sharding for transactions. They don't split up the smart contract execution. They have a single ledger for the smart contract execution, which means that it's a smart contract execution is much slower than just nominal transactions. But in Elrond has the ability to break up the smart contract state, as we showed in this diagram here, and to take advantage of this state sharding for smart contracts, which is a huge deal. Immensely speeds up their performance in smart contracts. But I do want to let me flip over to Charles Hoskinson here, just to kind of cross suppose this with I think you could say that Elrond's biggest competitors are ETH 2.0 and Polkadot, the other major shard networks they're doing interesting things, and they have a leg up with their adaptive state sharding and the ability to also do smart contracts with that adaptive sharding. But let's listen to Charles talk about why Cardano didn't go down this path. Just explain that.
Charles, could you please talk about what sets Hydra apart in terms of sharding? It sets it apart because it doesn't shard. It's a layer 2 protocol, and that's the power of these things. You want to do two things at the same time. You want to have a path that if you have to shard the ledger itself, you can do that in a very explicit or implicit way. Implicit is sidechains, explicit is what ETH2 is trying to do, where they actually have multiple ledgers and they're all interoperable and communicating with each other and spun up and down. Then you have to have a system where you can gracefully take transactions, batch them, and run them off-chain outside of the system. That's what Lightning does and what Hydra is aspiring to do and so forth. They are complementary, so you can do both at the same time. The advantage of any level 2 solution is it does not require a soft and hard fork for Cardano, and the stake pool operators can run these channels, and they're already trusted to be operators, so they can reuse their pledge and bonds and these things to basically facilitate the state channels. So we get that for free. It's low-hanging fruit. You can have competitiveness in the implementation. It gives you a path to a DEX. It gives you a path to interchain interoperability, and it can scale to millions of transactions per second if you want to do that. Brain dead obvious, low cost, super high return, and you leverage years of prior results and research for these things. In terms of ledger sharding, super complicated. The security of your system scales down to a third to a quarter. You have to introduce a lot of usually trusted centralized infrastructure to bootstrap it or create fail-safes as you're getting the system out. And Byzantine behavior dramatically reduces the performance of the system, dramatically. So when everybody's honest, the system is probably very fast. When you have an event, the system slows down. That's why Ghost and Phantom and these other DAG protocols didn't work out the way that people intended. So it's not all it's made up to be, and you get massive complexity creep into the system. So if you have two options, one is saying, I can easily add this on, it fits my consensus model, I don't have to shard the base ledger, and I get so much great stuff from it, and it's low cost, high return. Or the other, I can go and have to do 5 years of research and figure a bunch of stuff out like ETH2, super complicated, easy to get things wrong, and I lose security embracing it. And the end result is both systems will have equivalent performance, probably better performance in the single shard system, because you can optimize the base ledger and segregate transactions accordingly. I would say Hydra is much better. It's much easier. It's much lower hanging fruit. And that's what you get when you have good system architects, good scientists, and a respect for the past. When you're in love with your own ideas, you get caught in a cycle of groupthink over and over and over and over and over and over again. Then at the end of the day, you end up in a really bad position where you just double down and embrace basically concepts that are counterproductive for being able to build sustainable ecosystems. So we wish everybody who's doing this ledger-based sharding well, but I think it's not the right time to do that. We need another 3 to 5 years of foundational research to get to a point where it's very promising. And there are certainly a lot of great approaches. Some people send me proposals from prominent universities asking for funding for their approaches. And every now and then I get super tempted to pursue it because they're legitimately good at angles. But let's not lie to ourselves. There's years worth of homework that has to be done, and the dog is going to eat it more than once. Hydra is ready to go in terms of concepts, in terms of theory. It's easy to understand, it's easy to layer on, and it fits our topology quite well. And you can implement it through a series of competing teams, building competing clients, so you get client diversity, and you can implement it in the sub-$1 million level for a lot of these proof of concepts, and in the $5 million level for a finished end-to-end product. That's your complexity class, your cost class, and that means you can have multiple bets, and then you can add more and more features like a DEX and interoperability, and with Bitcoin and Ethereum, and all these types of things with that type of a system. Makes a lot more sense. Gradual escalation. Don't throw the whole baby out with the bathwater.
The question was asked: what tech aspects make Elrond superior to ADA? Two things. One, it's a single layer, right? So they have a lot of advancement in the single layer architecture, and it's a native multi-asset based ledger as well. So without having to have a layer 2 scaling solution, which is what Hydra is, right? Hydra is sidechains. So sidechains is a form of layer 2 scaling. And these sidechains in Hydra work a lot like Lightning payment channels, right? They work very similar to Lightning payment channels, and it's a very easy to understand architecture, but it's not as advanced, right? So definitely Elrond is a little bit more advanced with the adaptive state sharding than with what Cardano's doing with scaling with Hydra. But both of them, at the end of the day, basically can scale to almost infinity, right? Well beyond what Visa can do today in theory, right? If the network grows enough, the key point that nobody ever talks about is you have to have enough nodes. So the network has to grow drastically. You have to have enough participating nodes, and you have to have enough decentralization of stake to be able to spin up enough concurrent nodes to do a lot of these the scaling mechanisms in place. So really kind of both of them are dependent on having the network. Now today Cardano's network is a little bit bigger, and then the stake, here's the other part of it we have to keep in mind, is that from a security perspective, the bigger this number is, the harder it is to take over the network. So in a proof of stake network, generally speaking, there are exceptions, you need 33% of the stake. So I need 33% of all of ADA, or 33% of all EGLD out there, to be able to freeze the ledger, to be able to take over enough nodes that I basically prevent transactions from being able to be completed. I need 66% stake to take over the network and start doing double spin. So by the time you have 66% of it, your incentive to crash the network is not very high, but you would need 66% in theory for both. Now, to get 33% or 66% of Cardano, that would take $30 billion or $60 billion. To get that same percentage of stake in Elrond would take a lot less. Where's Elrond at? It's a $3 billion market cap. It would take $1 billion to $2 billion, right? So that's not a tech aspect, but it is technically superior as far as the base layer, okay? The other part of it that I really think is super interesting is the WASM VM. There's some really cool stuff with that, and just like Cardano, it's a base. They're really, at the end of the day, to be honest with you, they're both just about infinitely scalable. They're both they have native multi-asset support, so you don't have to pay all these crazy gas fees for moving from one token to another that's created. It's the same fee as moving, like say Ethereum would be, or moving native Cardano, like really, or Elrond, right? So moving EGLD is fractions of a penny, and then once you have native multi-asset, once you have multiple assets deployed on Elrond, being able to move from one to the other. Both Cardano and Elrond have these unique characteristics about them. They went about it different ways about how they built the architecture, but so technically speaking, I mean, it is more advanced, right? So that's, but also you can read in they're more complicated. And then the other, and to answer the question here, make Elrond superior to Cardano. Yeah, I mean, that's pretty much the gist of it. They do have the Myar. So there's a Myar wallet. Their wallet, I would say honestly, outside of the core blockchain, the wallet experience is probably better with the Myar wallet's probably better than Yori wallet or Daedalus for sure. The Maiar is also going to be a full exchange, right? So the Maiar exchange is going live here pretty soon, and they really do have a beautiful interface. And so that's maybe a both these are both very much next gen blockchains that once fully rolled out. And the other key advantage that Elrond has is it's rolled out today. It has a year of running. So that's a very important point that I need to probably make more highlight of, is that they've been running for a year. They have, I think, currently 4 shards in the network, right? They've been running for a year, up to 4 shards now. They've got a lot of things rolling out here pretty soon. So technically, they're also ahead. Cardano's rolling out smart contracts on the 12th. So they don't even have smart contracts yet, and Elrond does. So that's a huge advantage. So that's probably the biggest advantage right now. Assuming September 12th goes well and Cardano gets smart contracts, the real world difference between the two is going to be very negligible. They're both going to be extremely adept layer 3, next gen, third generation blockchains. So it's just a matter of which one gets, as I put here at the very bottom, real world marketing adoption. The biggest advantage to Elrond is just right now, if you're looking to get into the space, I can't recommend buying Cardano at almost $3 after the run it's had. I can recommend buying, if you don't have any, maybe buying just a little bit and then buying the dips from here. But what I don't know is, obviously probably on September 12th, we're going to have, this was Mary's hard fork back over here. So we had a bit of a spike, and then we had a little bit of a sell-off with Mary's hard fork, and it went sideways mostly for the most part, right? So most likely Cardano is now going to consolidate up here in this $2.40 to $3 range. So not the best time to try to buy. Maybe wait for it to consolidate a bit and then wait for the next breakout to really add, or wait for a nice dip, right? One way or the other. I can't really advise people buying Cardano here, right? It's just it's now. I was telling people to buy it at 9-10 cents when it was a $3 billion market cap, just like Elrond is today. So that's the other major thing, is that if Elrond, if we look back at the risks here, real world adoption, marketing, and clout. At the end of the day, all of these projects outside of Bitcoin, they have founders, they have teams, they have investors, they have all kinds, and how much clout do they have in the world to be able to get adoption, right? If you have two networks and blockchains that are basically infinitely scalable, they can do all this stuff so much better than what we have today. The next thing is just adoption. And it's, do you have the ability to go, and how's your developer community is probably the most important thing. And I will say the Elrond community is very helpful and very strong for the most part. So they have a very great community, that's for sure. And then the other piece of it is how much clout does your team have, the team that's running it, have to sign deals. And maybe an advantage for Cardano there, but again, Cardano is 30 times the market cap of Elrond. So really at the end of the day, what we're looking at here is we're looking at the potential of Elrond making some noise and becoming a major competitor and shooting up to the top 10. I think Elrond belongs to the top 10. I think Elrond's a superior project to Solana. This is an example. Solana's got a lot more VC kind of cap. They have the backing of FTX, really, at the end of the day. But there's a lot of problems with Solana, and Elrond is more advanced than Solana from a blockchain perspective. Honestly, it's a more advanced system. So what I'm kind of looking at is the market figuring that out and putting Elrond up here with Polkadot where it kind of belongs. Right? It belongs up here, easily in the realm of it depends on adoption. Totally depends on adoption. Probably at least in the realm of Steller, the top 20 vet and Steller here, and Matic. It at least belongs up with these guys, I would say. That's a big move. It really belongs in the top 10, mostly because a lot of these need to drop out of the top 10. But that's just my opinion. So it's kind of market opportunity. What's your thoughts of DAG protocol? So is this an actual directed acyclic graph DAG?